Something is happening in the silver market right now that should concern anyone who understands how fragile financial systems truly are. Not because volatility is unusual, not because markets never correct, but because what we are witnessing feels engineered, coordinated, timed. And when you look closely at the mechanics beneath the price action, you begin to see the outline of something far bigger than a simple trade gone wrong. Silver is not just another commodity, it is money. It has been money for thousands of years. Long before digital ledgers, long before central banks, long before debt-based currencies expanded into the trillions, silver served as a store of value and a medium of exchange. It is embedded into the DNA of civilization. And whenever silver begins to move violently, history tells us that something deeper is shifting. Before you go any further, make sure you like this video, subscribe to the channel, and turn on notifications so you never miss what's coming next. Drop a comment below telling me where you're watching from and what time it is in your country right now. Now, let's return to the topic. Right now, silver is experiencing extreme turbulence. Massive price swings, sudden drops, violent rebounds, margin hikes stacking on top of margin hikes, inventories draining from major exchanges, physical supply tightening. And at the center of it all, a short position so large that it exceeds the available registered supply in one of the world's major futures markets. Pause and think about that. A single short position larger than the physical stockpile available on the exchange where it trades. That is not normal market behavior. That is systemic stress. To understand what this means, we need to step back and examine how the silver market functions. Most silver trading does not involve physical metal changing hands. It involves contracts, paper promises, representing silver. Futures contracts allow traders to speculate on price movements using leverage. That leverage magnifies gains, but it also magnifies risk. When positions become outsized relative to the physical inventory backing them, the market becomes fragile, extremely fragile. Now imagine a scenario where someone aggressively shorts silver, betting that the price will fall, at a scale that exceeds the exchange's entire warehouse stock. Not 50%, not 80%, more than 100%. And then imagine that the account becomes frozen, unable to adjust or cover for weeks. What does that do? It turns the market into a coiled spring. A short position that large must eventually be resolved. If prices rise, losses compound rapidly. If physical demand increases while inventory declines, the pressure intensifies. Every ounce withdrawn from warehouses tightens the noose. Every margin hike forces leveraged players to reassess their exposure. And here is where it becomes critical. When inventories begin falling at the same time as margin requirements rise, the market is being squeezed from both ends. Physical supply contracts. Paper leverage becomes more expensive. Speculators get pushed out. Volatility spikes. We have seen inventory drawdowns of staggering size in a matter of days. Tens of metric tons exiting vaults. Warehouses shrinking. The ratio between paper obligations and physical silver stretching thinner and thinner. This is not a quiet environment. It is an unstable one. Now ask yourself, why would someone attempt to short silver at such scale? What is the objective? Profit, of course. But profit from what? From triggering panic? From accelerating a decline? From forcing liquidations? Large short positions can create cascades. If the price begins falling sharply, technical levels break. Stop losses trigger. Momentum algorithms amplify the move. Retail traders panic. Weak hands sell. And in the chaos, those positioned correctly extract enormous gains. We have already witnessed flash crashes where silver fell double digits in a single session. Moves that would once have been historic now feel almost routine. 10% up, 10% down. Numbness sets in. The market becomes desensitized to violence. But behind the volatility lies a deeper question. Is the silver price reflecting natural supply and demand, or is it being strategically pushed? Because here is the paradox. On one hand, industrial demand for silver continues expanding. Solar energy infrastructure requires vast quantities of it. Electronics rely on its unmatched conductivity. Medical applications use its antibacterial properties. Emerging technologies embed silver into their foundations. Safe haven demand increases whenever geopolitical tensions escalate. On the other hand, price action periodically collapses with stunning force. If demand is structurally strong, why do we see these violent downward episodes? One possibility is that paper markets overpower physical realities, at least temporarily. When leveraged shorts flood the market with contracts, they can overwhelm buying pressure. Price becomes a function of derivatives, not metal. And if those derivatives exceed the physical supply available for delivery, the entire system begins to resemble a confidence game. Confidence is everything in financial markets. The moment participants question whether contracts can be honored with actual metal, cracks form. Now layer in margin hikes. When exchanges raise margin requirements, they force traders to post more collateral. This reduces leverage. It squeezes speculators. It can cool overheating markets. But repeated, rapid margin increases during volatility have another effect. They intensify stress. Traders who cannot meet new requirements must liquidate. Liquidation feeds price swings. Swings justify further margin changes. The cycle compounds. And while all this unfolds, physical silver continues leaving vaults. Why? Because when volatility erupts and trust wavers, some participants prefer metal in hand rather than paper promises. They withdraw. They take delivery. They move silver off exchange. Every ounce removed reduces the buffer supporting the derivative structure. Now imagine being short more silver than exists in registered inventory. Every withdrawal becomes a threat. Every uptick in price compounds exposure. Every geopolitical headline adds fuel. And geopolitics matters. When embassies issue warnings, when regional tensions escalate, when trade disputes intensify, when energy corridors become unstable, capital seeks refuge. Historically, gold and silver have absorbed that fear. They become insurance. So what happens if geopolitical fear rises at the same time that an outsized short position sits frozen in place? You have the ingredients for a squeeze. Not a minor squeeze, a structural one. History has shown us that when leverage collides with scarcity, outcomes can be explosive. Markets can move far beyond what analysts deem reasonable. Prices can overshoot both directions. Stability can vanish overnight. But there is another layer. Silver is not just an industrial metal. It is a monetary barometer. When fiat systems expand debt aggressively, when currencies lose purchasing power, when central banks print to stabilize markets, precious metals often respond. They are the shadow measure of currency confidence. If silver rises sharply, it sends a message about inflation expectations and systemic fragility. If silver is suppressed, it can temporarily mute that signal. So ask yourself, in an environment of rising global debt, persistent inflation pressures, and geopolitical fractures, would a runaway silver price be convenient for policymakers? Or inconvenient? That question does not require conspiracy to explore. It requires understanding incentives. Stability in financial optics matters. Confidence in currencies matters. Bond markets depend on trust. Equity valuations depend on liquidity. A surging silver market can be interpreted as a warning flare, and warning flares are uncomfortable. Now consider the timing of margin hikes, inventory withdrawals, massive shorts, and volatility spikes. Coincidence? Possibly. Markets are chaotic. But when patterns repeat, analysts must at least examine the structure. Silver has already tested astonishing price levels recently. It has surged to heights many considered impossible. It has collapsed violently. It has rebounded again. Investors who remember buying silver in the teens now watch it trade multiples higher. Psychological anchors have shifted. Some participants bought near recent highs. Others accumulated during dips. Long-term holders view volatility as noise. Short-term traders view it as opportunity. Institutions view it as risk management. But beneath all perspectives lies the same physical reality. Silver supply is finite. Mining output cannot instantly scale. Recycling responds slowly. Industrial demand does not vanish overnight. And investment demand can surge unpredictably during crises. If paper contracts vastly exceed available physical supply, then the system functions smoothly only as long as confidence persists. If confidence breaks, the scramble for metal becomes real. This is why an outsized short position is not just a trade, it is a stress test. If the price continues falling, the short profits. If the price reverses violently while inventories shrink, the short faces escalating losses. If the market senses vulnerability, it may deliberately push against it. Markets are not moral. They exploit weakness. And right now, silver feels like a battlefield between paper leverage and physical scarcity. The coming weeks could determine whether this was a brilliant trade, a reckless gamble, or a catalyst for something much larger. Because when leverage collides with limited supply, history rarely delivers calm outcomes. This is not about predicting an exact price target. It is about recognizing structural tension. Silver does not move in isolation. It reflects currency health, industrial expansion, geopolitical stress, and speculative positioning all at once. And when all those forces converge during a period of extreme volatility, something breaks. The only question is what? When markets enter periods of extreme distortion, the first casualty is clarity. Prices begin to move in ways that no longer align with traditional metrics. Analysts scramble for explanations. Commentators offer surface-level narratives. But beneath the noise, structural imbalances quietly intensify. Silver is currently operating in that distorted zone. Consider the psychological dimension. When daily moves of 5 to 10% become routine, participants adapt. What once triggered alarm now triggers indifference. This normalization of volatility is dangerous. It signals that leverage is dominating price discovery. It means traders are reacting to margin calls and liquidity constraints rather than supply-demand fundamentals. And yet, fundamentals matter more than ever. Industrial demand continues expanding structurally. The global push toward electrification and renewable infrastructure consumes vast quantities of conductive materials. Silver's unique properties make it difficult to substitute without performance loss. Meanwhile, electronics manufacturing, medical applications, and advanced technologies rely on consistent silver inputs. This demand does not fluctuate wildly day to day. It builds steadily. At the same time, mine supply growth is constrained. Discoveries have slowed. Permitting processes are lengthy. Production costs are rising. Energy inputs are volatile. Recycling contributes, but it cannot instantly fill structural deficits. So if physical demand is steady to rising and supply is constrained, why does price collapse so violently at times? The answer often lies in derivatives. Futures markets allow participants to create enormous notional exposure with relatively small capital. When short interest expands aggressively, it can overwhelm buying pressure temporarily. Price becomes disconnected from immediate physical flows. But derivatives ultimately anchor to reality. If too many claims exist relative to deliverable metal, tension accumulates. Now add margin hikes into the equation. When exchanges raise collateral requirements, they alter behavior. Highly leveraged traders are forced to reduce exposure. This can push prices lower initially if longs liquidate. But it can also set the stage for future instability if shorts remain concentrated and physical supply tightens. 3 margin hikes within a short window signal stress. Exchanges respond when volatility threatens clearing stability. They seek to protect the system. But repeated increases can also amplify fear. Fear drives withdrawal. Withdrawal reduces available inventory. Reduced inventory increases vulnerability. Meanwhile, geopolitical tensions simmer. Trade conflicts disrupt supply chains. Energy routes face uncertainty. Military posturing increases in certain regions. Diplomatic warnings intensify. In such climates, safe haven demand historically strengthens. Gold typically leads. Silver follows, often with greater percentage moves due to its smaller market size and dual industrial monetary nature. Now imagine a scenario where geopolitical fear accelerates while a massive short position remains exposed and frozen. The market recognizes that vulnerability. Traders begin positioning for a squeeze. Physical buyers accelerate purchases. Vault withdrawals continue. The short cannot easily adjust. This is where feedback loops emerge. Rising prices trigger short covering. Short covering accelerates price rises. Momentum funds pile in. Retail interest spikes. Media narratives shift from collapse to breakout. Psychological sentiment flips rapidly. Markets do not move linearly. They move in cascades. But there is a second possibility. If coordinated selling pressure continues, if additional paper supply floods the market, if margin requirements keep increasing to suppress speculation, price could remain capped despite tightening fundamentals. Confidence in the derivative structure could persist longer than skeptics expect. This tug-of-war between physical scarcity and paper leverage defines the current moment. Another factor often overlooked is currency debasement. Global debt levels remain historically elevated. Monetary authorities have demonstrated willingness to expand balance sheets during crises. Inflationary pressures, even if moderated temporarily, remain embedded in structural deficits and fiscal commitments. Precious metals respond not just to immediate inflation data, but to long-term trust in currency stability. Silver's recent journey to triple-digit price levels shattered psychological ceilings. It proved that under stress, the metal can reprice dramatically. The subsequent decline does not erase that memory. It establishes precedent. Market memory matters. Participants who witness previous surges know that extreme moves are possible. They position accordingly during dips. Long-term holders accumulate on weakness. Short-term traders attempt to exploit volatility. And through it all, physical metal continues leaving exchanges. When inventories fall by large percentages within days, it signals either strong demand or strategic repositioning. Both tighten supply. Both increase the fragility of the paper structure. Imagine the ratio of paper claims to physical metal as a stretched rubber band. As more contracts stack atop limited supply, tension builds. The band can stretch remarkably far, but not infinitely. What snaps it? Sometimes it is a delivery default. Sometimes it is a geopolitical shock. Sometimes it is simply a loss of confidence that triggers widespread physical withdrawal. No one rings a bell before it happens. Those who understand monetary history know that precious metal markets have repeatedly exposed systemic weaknesses. They act as pressure gauges. When financial systems overextend, metals often signal distress before broader recognition occurs. That is why extreme positioning in silver is not trivial. It is diagnostic. If someone attempts to crash silver through outsized shorts, the immediate effect may be price suppression. But the secondary effects can be counterintuitive. Suppressed prices encourage physical accumulation. Accumulation reduces float. Reduced float increases squeeze potential. In trying to push the price down, one can unintentionally create conditions for explosive upside. This paradox has played out before, across various commodities. Concentrated shorts sometimes become fuel for rallies, especially when supply constraints exist. Now consider investor psychology at current price levels. Many remember buying silver below $20. Seeing it above 50 once seemed extraordinary. Watching it test triple digits felt surreal. Yet here we are, in an environment where even extreme levels feel conceivable. That shift in perception is powerful. When markets redefine normal, volatility expands. Price targets once dismissed become debated seriously. Long-term forecasts of dramatic appreciation no longer feel absurd. But risk remains on both sides. If industrial demand weakens unexpectedly due to global recession, silver could face headwinds. If liquidity crises force indiscriminate selling, even safe haven assets can decline temporarily. If regulatory interventions intensify, paper markets can distort signals longer than fundamentals justify. However, none of these possibilities erase the central structural tension. A market where paper exposure can exceed physical availability is inherently unstable. And instability eventually resolves. The question is direction and timing. If physical shortages intensify while short exposure remains elevated, upside resolution becomes plausible. If economic contraction suppresses demand and strengthens the currency environment, downside pressure could persist. Yet even in downturns, long-term monetary debasement themes reassert themselves. Silver occupies a unique intersection: industrial necessity and monetary hedge. That dual identity amplifies its volatility, but also strengthens its long-term strategic role. When someone attempts to overwhelm such a market with extreme leverage, they are not merely placing a bet. They are testing the architecture of the exchange itself. And architecture under stress reveals its weaknesses. Over the coming months, watch inventories. Watch margin policies. Watch geopolitical developments. Watch currency trends. Watch industrial data. But above all, watch confidence. Because silver ultimately trades on confidence in paper versus trust in tangible assets. If confidence in paper remains intact, derivatives can dominate longer than critics expect. If confidence erodes, physical metal will command a premium beyond futures pricing. The current situation feels less like ordinary volatility and more like a confrontation between two forces: those leveraging paper to influence price and those accumulating metal in response. History suggests that when such confrontations escalate, the outcome is rarely subtle. We are standing at a pivotal moment for silver, where leverage, scarcity, geopolitics, and monetary uncertainty are colliding all at once. Whether this attempt to overwhelm the market succeeds or backfires, one truth remains. Markets built on confidence can shift rapidly when that confidence is tested. Silver has weathered centuries of financial upheaval, and it will outlast any single position, any single strategy, any single attempt to bend it unnaturally. The only question now is not whether volatility will continue, but who will be prepared when the pressure finally resolves.